Real Estate Roundtable, and I want to thank you so much for joining us today. I am excited to have with me today Kareem Baldwin. Kareem is a mortgage loan originator, and he is with Atlantic Capital Corporation, and he's going to share so much with us today. Again, for those joining us on the webinar, if you have questions, please put them in the Q&A. We will answer as many of them as possible. And if you're on Facebook Live, yes, we will answer your questions as well. Kareem, I know you're in great demand because I already received questions for you today, which I will share with you. But before we start off, again, just welcome to everyone. But Kareem, how about introducing yourself and telling our viewers a little bit more about you and what it is that you do, and then we will dive right in and talk all things mortgage.
Okay. Yeah. Hello, everyone. I'm Kareem Baldwin. Been in the mortgage industry for 13 years now. I'm 34. So yeah, just love everything about numbers, financing. So anything with getting funding to acquire property, that's pretty much what I do. So if it's commercial property, residential properties, foreclosures, anything where you will say, okay, I need to get funding to buy this house, that's what I do.
Okay, well, we love funding, right? Everybody
Yes,
wants
yes.
to get their
That's
goal.
a major part. A major part.
Exactly. I don't think we can go very far without funding unless we're doing an all cash deal, right? Outside of that, we're gonna need to come to someone like you, and we're gonna, have all these questions. And although we're gonna focus today a lot on refinancing and non-traditional loans, why don't we start off, however, by talking a little bit about what are mortgage rates like today? What's happening today in the current marketplace, and just give us some thoughts on that. What's happening today?
So rates are really low. So with mortgage rates, it's kind of how the economy's doing will determine interest rates. So with everything with COVID and all the job reports and all the bailouts, that pushed the rates pretty low. So right now is like a great time to refinance. If your interest rate is over 4%, you should definitely refinance because rates are, 3%, 3.25%, 2.8, depending like on your credit score. So I've gotten people that, 2.75 on a 30-year fix. So right now is definitely the time because of what's going on in the market. So as we get like closer to the election, people are saying that the rates will go back up just for, economy reasons. People want to win, so they have to push the economy. So that will then, push the interest rates back up. And then after the election, they'll probably end up coming back down, which is what happened 4 years ago. Rates were low. President came in, rates went up. And then as he was in office, the rates started going back down. So politics play a big factor in the market.
Are you sure about that? You're telling me that politics have something to do with what we're going to pay for our mortgage? That's unreal. But
it does. Yep. Everything, the global market, politics, it's all, we're all involved with it, whether we want to or not. I try to stay out of as much politics as possible, but it's so, part of our everyday life. Even if we don't know about it, it's still something that whether it's a rate or how the property values are, it's always something. So
always something. Wow. Right. Well, you just said that you were able to get someone for less than 3%. I mean, yes. That is unreal. Are you seeing a lot of that? What are the factors that come into play? So I'm sure someone else will see it and they'll say, I definitely want a 2.7. But you just said you've gotten that, and you're suggesting that anyone who has a current interest rate of over 4% to refinance.
They should definitely be refinancing. The credit is a major part of the interest rate when you're refinancing. So anything over like a 720 credit score will put you in like the A1 box. But if you're below that, you can still, possibly get a 3%, 3.25. So like I said, if you have over 4%, it's definitely the time, because you'll be able to get something lower, because the rates are so low that, you know, that excellent credit may be 2.7, not so great credit's 3.2. That's still a really good interest rate. So you don't even have to say, well, let me wait 5 months to fix my credit. By the time you do all of that, you can miss the boat. So if the payment makes sense, the cost makes sense, I say, you know, do it.
Okay. All right. So if you're listening to us and you are paying more than 4% on your mortgage, it's time to refinance. That's what the expert is saying. And so you might just want to have a consultation with him afterwards, and I'm sure he'll be happy to do that. But
Yes,
we're going
definitely.
to dive further in. So let's speak specifically about FHA, streamline, refinancing, and
Okay.
cash out. Tell us more about that, because there's so many terminology and there's so many different loans, and we don't, most consumer, they don't understand everything. We hear the typical one. There's a lot that we hear on the news, or our cursory research will show us certain things, but at the end of the day, we're not diving deep into it. This is what you're living day to day. So educate us.
So with the streamline, that just means that, well, what streamline means is just like a faster process. So if you already have an FHA loan, so let's say you have a FHA mortgage, you bought your house, you did an FHA loan, you would do a streamline refinance, which would mean no appraisal, no income documents, no credit score. So it's basically taking the FHA loan that you have now, keeping you into an FHA loan. Is just a lower interest rate. So that's what a streamline would be. So if you don't have an FHA loan, you wouldn't be able to do an FHA streamline. That's for someone that already has an FHA loan. They've made at least 6 payments, and now they want to refinance to a higher rate. Since you're lower rate, excuse me, since you're already in an FHA loan, you're not going to go through the same underwriting process. That's why you're not going to have to worry about your income documents, your pay stubs, your bank statements, tax returns, appraisal. None of that is needed. So you just send over your insurance, your ID, could pretty much go over your job information. We're still going to verify you have employment, but you don't have to, you know, show your income and qualify with your income again. You just still need to be employed. That's all.
Oh, wow. I
And
mean,
that's like a 2-week process, because there's less needed, so it's going to move faster.
so what I hear you saying is, I have a mortgage. I can pick up the phone and call you, and I can just come with a letter that I am still employed. My employer, I'm still verified.
You don't even need a letter. It'll be a phone call. So you don't even need the letter. You just need to give us a phone number, and they'll call and verify. But you have to have an FHA mortgage to do that. So that's why it's a streamline, because it's only for FHA. If you don't have an FHA loan, the high rate, you would go through the standard process verifying income. We are seeing a lot of appraisal waivers where you're not doing appraisals. So the COVID thing kind of helped with that, because now people are like, hey, I don't want anyone in my house right now. So we're like skipping the appraisal process. So you can buy a house without an appraisal, or you can refinance your current house without getting an appraisal.
So for those listening, this is what I am hearing: no appraisal, no income verification, no credit, and having only made 6 months payments, you can now refinance and get a much lower rate if you have a high interest rate now. I see that we have a question. I'm just gonna try to see if we can answer this question right now, and then we will continue.
I didn't see all of it. It just said, what about, I didn't see the rest.
Right.
Are you going to read it, or I'll let you read it?
I'll read it for you. How about loans made through SONMA, the SONMA program?
Oh, okay. Yes, because that's not a government. Well, I shouldn't say that. That's not an FHA loan. So you could still refinance, but you would still have to go through like a regular refinance process. So it wouldn't be a streamline, because it's not an FHA. FHA streamline means FHA loan, staying with an FHA loan. You have a Sony Mae loan or any other government agency with a grant. So a lot of times with those grant programs, you have to look at your paperwork because you may have to wait a certain amount of time to refinance because they may want you to pay that stuff back. So if you got a grant, hey, you have to be in the loan for 5 years or 7 years or 10 years. If not, you owe us X amount of dollars. So we can go over that information, look at your documents that you sign. It will pretty much say, hey, you got a grant from us, so you have to wait a certain amount of time before you can do anything. Sorry.
Okay. Okay, so that's conditional on exactly what's in the agreement. And then perhaps if you have, this is something that you have been paying for a time, and if there was a time restriction for which you had to wait before you can refinance, then once you have done that and you
Calling
have
me and
waited.
someone was calling me. I tried to end it and I ended the Zoom by accident. So sorry about that.
That's okay. That's
So yeah,
okay.
with any type of loan where you got some type of grant financing, usually there's like a stipulation on how long you have to stay in that mortgage before you can refinance or sell the property, or you'd have to pay, whatever money you got back. So we just have to weigh the pros and the cons of that. I've had people refinance early, pay the grant back because it was still beneficial for them. So depending on the situation, it may be worth it. It may not be worth it. Like, hey, just wait. So we'll just have to see. That's like a specific case right there. But she
Okay.
could refinance. So the answer is yes, it's possible, just not with the streamlined program that we're talking about.
Well, that's good to know because I'm sure others have that same question. They have different programs, and I'm certain that you'll be happy to evaluate the very specific case that this person has, and
Yes.
inform better, able to help her in guiding her then. And when you talk about, now we're going to go back to like a VA cash out, cash out finance or refinance. What are we talking about there?
So cash out means paying off your current loan that you have and then adding any additional funds on top of that. So if you have a first mortgage, you want to pay off some debt, you want to take money out to renovate the property, college fund, just extra money for vacation, whatever it is. So once you're adding money on top of your principal balance or taking equity out of the property, which is accumulated value in the house, that's what will be considered cash out. That's for VA, that's for FHA, that's for just conventional. So all across the board, if you want to take money out, use the equity in your home, that will be considered a cash out refinance.
Okay, and are you seeing a lot of those now? Because
Yes, because
yes,
the rates are so low. So people are either refinancing, just taking a lower rate, or people are refinancing, taking a lower rate, and getting the cash out. Because if you do like a line of credit or you get a second mortgage, that interest rate's going to be higher than the rates that you have now. Plus, those rates are usually not fixed; they're interest only. So people end up having to refinance anyway. So instead of getting a second mortgage today and then 6 years from now having to refinance, better off just taking that money out, doing a 30-year fix, getting that lower interest rate, and then you don't have to worry about touching it over and over again. So a lot of people get caught up with, okay, I'm gonna refinance, second mortgage, then they're right back to us the next year, then they're right back the next year. So the plan is to kind of take advantage of the low rate and then just keep paying it down, unless you want to just keep taking money out. So there's different ways to do it. Certain people, they don't like doing that. They want to leave the house for their kids, whatever it is. So you definitely want to get a lower rate and then try to do what you can, at that one shot. For any reason you have to do it multiple times, of course, you can't do anything about that, but you'd want to, just try to do what you can all at one shot.
so let's make sure we understand you better. How much can you take out if you're going to do a cash out? How much can you take out, and what does that look like when you refinance the property, and you have to
So
now pay the balance on it, and then what are we doing here?
So for FHA conventional, you can take out 80% of your value. So whatever your house is worth, you would times it by 80%. And then whatever that amount is, that's the maximum loan that you can have on your property. If you're a veteran, you're doing a VA loan, you can take out 100% of the equity in the property. So if your house is, worth 300,000, you owe 100,000, you can take a loan of 300,000 for VA. VA will allow you to cash out 100% of the equity in the property.
Okay. Are there any other loans that would allow that besides VA?
No. VA is the only one for 100% cash out. Any other loan program is going to be 80%.
80%.
Yeah. So whatever your house is worth, you can go online or talk to you. Hey, let me know what my house is worth. That's your specialty. And then they can times it by 80%. Yeah. And then they can kind of get an idea of, okay, well, this is my max loan. So my max loan is 400,000 and I owe 350. Then I can, probably only get 50,000. So depending on, what you owe, that will determine a lot.
Okay. And with the VA, so we spoke earlier about the FHA and their streamlining. Is the VA streamlining the same?
VA streamline is the same, yes. So no appraisal, no income. You have a VA loan, you just get another VA loan, but that's not cash out. So when we're doing the streamline with VA or FHA, that's only to lower your interest rate and payment. That's not to take cash out. If you do a cash out, you have to, of course, now show your income. So for whatever reason, if you're not making as much or you went to be self-employed and something else changed with your income on the books, then the streamline would make the most sense for you just to get a lower interest rate. But if you wanted cash out, you'd have to, verify all your income, all your credit, everything like that.
I think that distinction is critical because when someone hears you saying, okay, you don't need the appraisal, you don't need the income, they might think they can get cash at that point as well. So it's important to realize that although they're both refinancing, one is where you can get cash, but that's going to require the traditional income verification, the traditional, appraisal, the traditional credits report. You're going to have to go through that process if you would like to get this to cash out. But if you would not like to cash out and you simply want to refinance so that you can get a lower rate, then you can go the easier route and just do a streamlined refinancing. And the distinction though between like the FHA and the other loans and the VA is that through the VA, you are able to take 100% out, but if it's another type of loan, a maximum of 80% is allowed.
Yes, 80% of your value. Yes, it used to be 85%, but that was pushed to 80. So at some point, I'm sure it'll go back up to 85. But right now, we're at 80 across the board.
And was that as a result, did that change occur within the last 3 months during the time of COVID?
That was before, like within the last year. So last year when it started. Yeah.
Okay.
So
I know before
all
COVID,
of this happened.
Okay. And there has been some changes in terms of requirements since COVID-19. Do you have any insights on that? Is that still happening where there were, some lenders were requiring that you put down a higher, loan to value, you needed to put on more than the 20%, or you had to have a set credit score. Are you finding that in your business?
For us, we haven't changed any of our requirements. So we've been actually getting a lot of business from the people that Chase told them 20% or this told them 30%. So we haven't had any of those issues. We're still using the same products, same underwriting. We did have like small changes with people that were self-employed. So you couldn't count as much as your self-employed income, but all of that is gone now. So now that the country's opening back up, a lot of places, so all of those like work requirements are pretty much lifted now. So we're back. We were back to normal before. We didn't have a lot of changes, but any changes we did have, they're all gone. So we're doing the same thing we were doing prior to quarantine and lockdown and all that stuff. So
Yeah, quarantine thing, right?
yeah.
Okay, you have mentioned self-employed a number of times. You take a quick minute to tell us what the distinction is in terms of what you're looking for when you're evaluating, you know, the ability of a self-employed person to repay the loan versus someone with a W-2. What are the things that you're looking for? How is that different? Because again, you've mentioned the self-employed. Can we elaborate just a little on that?
Yeah, so for people that are self-employed, usually you're not, you know, when you, I guess I'll start off, when you're W-2 and you get your paycheck, every week it already has taxes taken out of it. So you don't really, you know, have to go and pay taxes. You may a little bit or whatever the case may be. But when you're self-employed, you're getting the full amount and then you pay your taxes during tax time. So a lot of people that are self-employed may say, okay, I made $100,000 in gross revenue, but then they tell the IRS they made $3,000, and then that's what trips them up with the mortgage, because now we're going to look at, you know, what you reported to the IRS. So if you tell the IRS you made $3,000, that's the amount that we have to use for people that are self-employed. So there's a couple ways around it. You know, certain things we can add back into your income, so your mileage, your depreciation. So not to get, you know, too deep in a rabbit hole with self-employed and like how to do your tax returns. I'm not a CPA, so I can't say that. But there's different ways that the IRS looks at your taxes and how we look at your taxes. We don't look at them the same. So when you're self-employed and you want to get a mortgage, it's important that you speak to your accountant as well as speak to a mortgage person to kind of determine, okay, you know, this is what I have to do to make sure I qualify. We do have a 1-year tax return program for people that are self-employed. So if you've been owning your business for at least 5 years, you only have to show 1 year of tax returns. Usually it's 2 years, and we would average those 2 years. So for a lot of people, they may say, okay, same thing. I showed $3,000 2018, but now, you know, I want to show 100,000. Well, we have to average that. So you have to show even more. So it kind of, you know, puts you in more of a bind with paying the IRS. So if you've had your business for 5 years and 2018, same example, you showed 3,000, 2019, you show 100, we would use the 100,000 to qualify and not have to average, which would put you even lower. So for people that are self-employed and buying property, I would say either, you know, have the money since you're not paying the taxes, or wait to your business to your at least 5 years where you only have to show 1 year of documentation. That's what I usually tell people to do.
Kareem, that's interesting. They're paying their taxes as self-employed. You know that. But you
I
may.
don't know. I've seen a lot of tax returns. So people, you know, people show what they want to show. And listen, I'm not the IRS. So whatever you have your write-offs, hey, whatever works for you. It's just you have to have something to compensate for that. So, you know, don't say you had a loss, but you don't have any money. It just, you got to have either or. Either paying the IRS or you're using that money and putting it as a down payment. So that's the best way to look at it.
I see. Okay. And in what you're talking about, that program where you're only looking at 1 year, and traditionally you're looking back at 2 years when you're thinking about a loan, is that unique to your company or is that across the board?
I'm not going to say it's unique just to us, because I know other people are doing it, but a lot of more like mortgage brokers are doing it. If you go to Wells, Chase, any of the big banks, they're not doing that because they know, okay, I'll just show more income. So for them, they're going to put, you know, more stipulations in front of you to qualify. That's why COVID, you know, you got to put 20%. You need a 740 credit score. So they're going to have more stipulations where we won't have as many stipulations. So it's not, you know, something that just I can do, because I'm not going to say that. But not everyone is doing it. So it is unique, just not only I can do it. So if you're in a different state, then I can direct you to someone that can still do something like that.
Okay, that's great. We have another question here, and it's saying, would you say that it is best to have 20% of the price of the home prior to going to the bank for a loan? That's one of the questions we're getting here on Facebook. So what would you say to that, Kareem?
I would say absolutely not, because I've done this math with a lot of people, because people come to me all the time, hey, I want to put 20% down. I'm like, okay, so let's do the calculations on 20%. And I'll say, well, let's look at 10% down. Let's look at 5% down. Let's look at 3% down. And people see that, wow, I'm putting 20%, but my payment's not decreasing as much as I thought it would, because the loan is for 30 years. So it's, putting that 20%, it may drop your payment, $200. So if you're buying bigger houses, 500, 600,000, we're talking about, $120,000, $110,000 to have to put an extra, $80,000 for $200. That's not worth it. So I always tell people I would put the least amount down and keep that additional money, because you never know what's going to happen in the market. You could put 20% down and then something happens where values go down. So all that money is pretty much lost, which is what happened to a lot of people for the first crash. They put 20% down. Now that house is not worth as much as it was before, and you pretty much lost your 20% compared to the person that put 3%. I didn't really lose much. I still may have lost something, but it's all about protecting your losses, because with real estate, you never know. It is something that can go up and can go down. It's still a great thing to buy. It historically, everyone knows, millionaires all have real estate. Everyone knows that. So it's all about, hedging those bets and hedging those losses and protecting yourself. So never going in too much and just making sure the numbers work. I'm a numbers guy. So to me, if the numbers don't work, I'm not doing it. If it does, then I do it. So.
Okay. Well, we have a follow-up to that question from another attendee of the webinar. The person is like, what about the PMI? Because traditionally, what you hear is everyone believes it has to be 20%. Now, before we go into the 3% or the 5% and what type of loans those are, and we want to discuss them, but I think this attendee brings up a good point. What happened to the PMI? When you think about PMI, what you're going to have to pay. Well, first, tell us what that is. So for those who don't know what it is, they can have an understanding. And why would you still suggest putting less than that 20%?
So PMI stands for private mortgage insurance. So the long and short of it is basically you as the person that's borrowing the money, you're pretty much paying for the bank's insurance, which is pretty crazy when you think about it. So because we have the power, so you have to come to us, and people take advantage. We know that. So you're pretty much paying our insurance. So the insurance that you're paying, that PMI, if you don't pay your house goes into foreclosure or whatever it is, that insurance would cover any losses or any difference in there. Now, with the PMI payments, if you have good credit or excellent credit, the PMI is pretty low. So it's not, something that's $300, $400 a month. I've seen PMI $80, $100. So it's just about the numbers. Doesn't make sense to put the 20% down. Certain people are just saying, I don't want PMI. They're against it. And with that, we just say, no problem. We take the 20% and we move on. So, we can't convince someone to do something. We can give them the option and say, hey, professionally, I don't agree with it, but ultimately, it is your choice. It is your decision. It is your loan that you have to pay back. So certain people, they're 100% against the PMI. I'm not one of them. I bought multiple houses. I have PMI in a house that I live on right now. So to me, it just made more sense to do the PMI. I just didn't want to put a lot of money down because I didn't need to. So
okay,
that's what I would say to PMI. The higher the credit score, the cheaper the PMI payment. So I would say you could do that. So the money you would spend to fix your credit compared to the 20% down, it would all still be cheaper for you to fix your credit, get the higher credit score, put the low money down, get the cheaper PMI. It'd still work out much better than paying 20%.
Wow. So it all goes back to your credit. It's like that is something you're hearing over and over. You're going to, get a better price, I guess, on the
yes,
money.
with anything, whether you're buying a car, credit cards, go to Home Depot, higher your credit score, you just have more leverage. Doesn't mean that you can't do anything. Doesn't mean that it still won't be affordable and great. It's just if you're at a certain tier, you'll just have more options. And to me, with real estate, it's about options. Sorry, I live by like a firehouse. So,
Okay.
they're doing those graduation things still. People like driving around and doing
That's what's
graduation
great about
ceremonies.
these Zoom Live. It's just like, it's natural. It's what's happening in
Yeah,
your life
you
right
never
now.
know. So
And so
that's what I love about it.
it's pretty good. But let's go back to 3% and 5% and 10%. Now in New York, as you know, like, it depends. There are some properties, especially condos and co-ops, that will not allow you to borrow to finance below a certain, above a certain amount. So you might find there are properties that the maximum financing is 65%, or the maximum financing is 75%. You know, especially on co-ops. And then on condos, you will find that traditionally, and there are exceptions to this, you will find that you're required to put a 10% down. Now, we just spoke about the PMI that you'll have to pay on that. But when we're discussing traditional single family or townhouse, where you're not going before a co-op board, or you don't have these restrictions, there are other loans that are available to a buyer. Let's talk a little bit about that. Let's talk about a loan that may be available to a first-time home buyer. What are some programs available out there? And just tell us a little bit more about putting down 3% or 5% and where are those loans coming from.
Yeah, so that's the same first-time home buyer. So the 3% is going to be based on the income for the area. So we look at the address, whatever that median income is for that location. Certain areas don't have an income limit. Certain areas do have an income limit. So if you make above that amount, then your minimum would be either going FHA and putting the 3.5% down, which would be, if you're talking about PMI, it's more expensive PMI, more expensive closing costs, or more expensive loan. Instead, you would just put 5% down, which would be a cheaper alternative for you payment-wise, loan-wise. So if you're a first-time home buyer, you're either going to put 3% if you make under a certain amount. If you make over that amount, you would just put the 5%. If your credit score is like fair, then I would just go FHA, put the 3.5% down, and then as you make payments, work on your credit, then you can go ahead and refinance, get out of FHA, and just get a conventional loan, because the PMI will be cheaper. And with FHA, if you put less than 10% down, PMI is on the loan for the entire loan. So compared to where if you just have to pay 20% equity, so for FHA, less than 10% down, you're going to have PMI for the entire FHA loan. You'd have to refinance out of it, which a lot of people do. So I'm like, hey, buy it FHA, stay in it for a year, 2 years, and then they refinance out of FHA, get conventional, and they're good to go. So.
Okay, we have another question here, but I want to follow up on that, because you're talking about FHA and conventional, and
Yes.
some people equate both of them to being the same thing and use them interchangeably. Tell us what's the distinction, because you'll hear someone say, I'm going to get a conventional loan, I'm going to get the FHA, and they're saying that's the same thing, but you're saying, no, that is not the same thing. What is the difference?
Yeah, so FHA is just a federally insured loan. So it's just a government insured loan. Conventional is not. So that's the main difference between the two. One would be a government loan, one would be a non-government loan. So the government loan has more stipulations, less credit score requirements. You can do a 580 with FHA, spare it's a conventional where you want a 620, 640. But for conventional, unless you have like a 680 credit score, I would go FHA, because it'll be a lower rate, lower payment for FHA. So again, with me, I'm all about the numbers. What's going to save me, the least amount of money per month, or what I have to spend the least amount per month. So depending on your credit, will either put you in the conventional box or FHA box. If your credit score is excellent, I would go 5% down conventional. You'll probably get a 2.875 if you're buying a house today and you had 5% down with over a 720 credit score.
Wow. That is good to know. That's the next question I had. The person said, "What is considered a good credit to buy a house?" So,
Um,
what would you say is a
there's
good credit to buy a house?
Well, it depends on the program. So depends on the type of house. So even when you got into co-ops, you have single families, you have condos, you have co-ops, you have multifamilies. So depending on the type of property would determine if you're going to go FHA or conventional. And then based on the mortgage program would determine, the credit score. But I would say across the board, a 640 would be a good score to have.
Okay. So a minimum of 640 would be good, but you
If
can't.
you're lower than that, you can still do something. But as I was stating before, you want to have the most options as possible. I have a lot of people buying houses now under a 640 score. It's just there's limited lenders for that product because once COVID hit, they pretty much said, if you don't have a 640, we're not really going to do anything for you. There's still like one or two banks left that didn't change anything as far as that. But now so many people are using them. So that process is going to take about 90 days to get that financing instead of, 30 days. So, and then when you're, bidding wars or you're going with other people or I want to like this house, someone else likes this house, the seller has two offers. One's going to take 90 days. Other one's going to take 30 days, unless you know them or you guys, have a great relationship, they're probably going to go with the person that's 30 days. So unless the house is just a house that, a lot of people really aren't interested in, then I would say pull the trigger. But if it's, houses, if you're in an area that a lot of people want to live in, then I would definitely, work on the credit first. So now you have more options and you can close a lot faster. But that's today. In a couple months from now, it could go back to that standard 30 days. But right now, if your credit score is lower, it's just a longer underwriting process.
Let's talk a little bit more about that because, we usually, even as a real estate broker, I'm talking to clients about getting a pre-approval. But then there are a lot of additional steps. The pre-approval is just the first step, and it's better than a pre-qualification. How about you as a loan officer now telling our viewers exactly what the distinction is and what exactly you are referencing when you say it's going to take about 30 days. Let's go a little deeper because for some, they believe, okay, so I got pre-approved. What is this 30 days? What do I need to wait for? So let's just break that down a little bit.
Yeah, so when you come to me, your pre-approval is I'm going to look at your income. I'm going to look at your credit. I'm going to verify your bank statement. I'm going to make sure that you're approved up to X amount. Once you find a house, once you go through that step, now it's, pretty much we're re-verifying everything because with lending and money, we want to make sure that what you told us today is still the same tomorrow. So we're not just going to say, okay, well, on Monday, they were working, so now they're good to go. We have to make sure on Tuesday that you're still working, your pay is the same. Everything is exactly the same. You didn't spend the money that you needed. So that 30-day process is that, that full underwriting process. I'm going to look at your documents today and say, okay, you have the money, your credit score is good, your job information is good. Once you find a house, now we have to verify that information again. So that's what that means. So that's why you have to go through a 30-day process. You need an appraisal. You need a title report on the property to make sure, there's no additional liens on the property. There's no additional liens on your name. So those are not things you would really do on a pre-approval. You would look at the credit, look at the income, bank statements. You wouldn't, do a title search because that's specific to a property. So unless you have a property, we really can't do a title search because that's based on like I said, specific address that you're going to buy, specific contract. You can't do an appraisal because you need to have a house in mind before you do an appraisal. So that's that additional time frame. That's where that comes from.
So you're taking those additional steps before.
Yes, we have to final. Yes, so before we can say, hey, you're looking good. Use this letter to go, show realtors, show Kaylin, hey, I'm good. Kareem said I'm good. And then now we have to make sure that you're still good. Because I've seen, different things. Even during this COVID process, people were working and then, hey, I lost my job or, my hours got cut. And that changes your numbers because you were approved based on this information. If anything changes on that information, then the numbers have to change. So a lot of people get upset about that. Hey, why is it changing? Well, you don't make the same, or, something popped up. So those numbers now have to change. So I always tell people to, put yourself in everyone's shoes. Put yourself in the lender's shoes. Put yourself in the seller's shoes. Put yourself in the realtor's shoes. If you're trying to put an offer in, don't try to lowball it. Because if you were selling your house and someone came to you and said, "Hey, this house is 300,000," someone said, "Hey, 250," you're gonna be like, "Get out of here." I'm not selling my house for that. So you have to also understand that as well when you're buying a property. Hey, this person, I know I wouldn't sell my house for undervalue. So why would why would I sell it to you? So that's a major thing that a lot of people just like skip past when they're buying a house. Like, oh, I'll just offer anything. And it's like, well, if that was your house, you wouldn't do that, or would you accept it? So it's just, trying to keep that playing field, even just being, understanding what's going on. People that do that, they have no issues. It's people that, want to look for something that's really not there. Then they end up 6 months, 8 months, a year later, still looking at houses. So you have to just, come to a conclusion, have a plan, speak to your realtor, speak to your loan officer. Everyone's on the same page, and you'll definitely find a house in no time.
Great. And how long does it take for the pre-approval? So,
that takes a day, so if you send your documents on Monday, depending on, how busy I am, a couple of days at most, 3-4 days.
Okay.
So
okay. And I
won't
always
take too
tell
long.
clients that it is essential to have your pre-approval, although it's not the commitment letter after all the evaluation, because as you said, Kareem, put yourself in the seller's shoe. Today,
Yes.
sellers are not allowing, most of them don't want you to show the property unless they see how much the prospective buyer is pre-approved for, or the buyer can show proof of funds. So you don't have to have a pre-approval. If you have money in the bag, you can show, okay, I have all of
There's
this.
my bank statement. I can do it. Yeah, which makes sense because, time is money. Realtors have to take time out to go. That person, you may have to take time out to drive to the house, or you took off work, or, you had plans, you canceled your plans. Seller, hey, I'm canceling my plans. I have someone coming over, but then they don't have any paperwork. So it's kind of like, what are we doing here? All that means is that you're committed. You want to get something done. So getting that pre-approval, having that approval funds, it just lets everyone know that, hey, I'm committed. I really want to get this done. But, I don't want to get a pre-approval. I don't need to get pre-approved. That's true. It's just you're letting everyone know you're not really committed to doing it yet, which is fine. Once you're ready, we'll still be here. We're not going anywhere. So if you say, hey, I'm not ready for another 6 months, that's fine. Take your time, move at your own pace. Don't feel like, you definitely need to get pre-approved today. No, take your time. Make sure you have everything you need. When you're ready, the door will still be here for you.
And I think that's important for prospective buyers to know. When a lender or a real estate broker like myself say to you, get pre-approved, we're not saying that you have to do it today because we want you to buy today. But if you are coming and you're saying we want to see homes today, then that's the necessary first step. But if you're not ready, and you want to continue to just look online or do a few things on your own, that's okay too. You can take your time, and you should take your time, because this is a very big decision. And so until you're truly ready, then you should not be making it. But when you come to the table, when you're approaching a seller, or you come with an agent, you're saying, I am coming to the table. I am ready to negotiate. I'm ready to make an offer. I'm ready to move forward. And so I need a seat there. But without, that pre-approval, and I mean, sometimes clients don't fully understand why it's necessary. And I think one of the good things probably from COVID is the fact that you can say to the prospective, you're not going to have as many open houses on a Sunday, just anyone walking around, because you have to coordinate it better, one, and you have to limit the time when someone can go in. And there are homeowners who are saying only individuals who are pre-approved will they allow in?
Yeah,
And
because it's a commitment issue. Like we were saying, it's about commitment. There's so many online resources. You don't, if you're not ready to just go online and look at houses online, you don't even need to do that yet. Because if you say, hey, I just want to see what's out there, that's fine. You can look online. Okay, I really want to see this house. Well, are you ready to do something then? If you see it, then you say, okay, I'm going to get pre-approved, because it's all about a commitment. You're making that commitment to say, you know what, I'm ready. If I'm not, no problem. When you're ready, get something done. So that pre-approval thing is big. I don't see that a lot. I still hear other people saying, hey, the person didn't want to get pre-approved. So when I hear that, that just lets me know, hey, that person is just not ready. So I always tell them, listen, when you're ready, let me know, or what's slowing you down from being ready. Maybe it's a credit thing. Maybe you think you couldn't really do anything. A lot of people say, oh, well, maybe I need 20%. So, I'm not ready to get pre-approved. So just having that open line of communication with the realtor, loan officers, letting them know, like, this is how I really feel. And that will go a long way. Just saying your feelings. Don't be afraid. Listen, we're not going to get mad. It's business. Yell at us, whatever you have to do to get us on the same page. That's what I always stress. We're
yeah,
not doing something, let us know. We're not mind readers. We try to be as much as we can. We try to be, but we're just not. So you have to let us know exactly what we need to do at certain points, and you'll definitely get something done.
great. I think you make a great point. It's communication. Communicate to us why, because sometimes what you're thinking, because you're not fully aware of what other options you have, you may think this is a hindrance. But if you speak to a knowledgeable real estate agent, or you speak to a knowledgeable mortgage lender, then you'll find out that there are alternatives, there are
Yeah,
workarounds. They're like,
that's the best part of our job. The questions, like, I love the questions, because that's why we study. That's why we take tests and exams and licensing. It's like when you go to the doctor, you're not just going to be like, oh, well, I'm not going to ask you any questions. People have a book, people doing all their research before. So treat it the same. Do your research online if you want to. Come to us with a, spreadsheet of questions, whatever it is.
yeah.
Keep us working, keep us busy. That's why we got our license. That's why we have to train. That's why we have to do all of these things to put it to good use. So,
Yeah.
let's use it. Force us to use it.
That's wonderful. A knowledgeable and professional mortgage lender and mortgage broker is going to go a far way. And getting those individuals together at the beginning of your journey is also essential, because it can make for a smoother transaction. It can make for a transaction that closes faster, and you get in the right things because you have your support, you have your guide, and that is picking the team at the beginning and picking the right team. So I just want to
Yeah.
thank you for that. We're going to wrap up soon, but I want to talk a little bit about no document refinancing. What is, our rate term and cash out, like investment properties, are they different? What are you talking about there? What are we
Yeah.
looking?
So for no doc, because this is like more of a New York thing. So New York State, no doc. Even if it's your primary residence, you can't do it. So that's something that they push more towards investment properties. So if you have an investment property, you can definitely do a no doc loan. You can refinance, it'll be 65%, or you can buy a house with no income in New York, it'll be 20% down. Other states too, you'll still put 20%, but certain states it may only be 10% or 15%. But speaking for New York, I'm assuming this is mostly a New York audience. So it
It is
depends. That's how
quite a mix. I have some questions from Michigan. I
okay.
have
So
another question coming up, and that's from Michigan. But we do have a large New York audience as
yeah,
well.
so I would say it would be something that's, if you want to do a no doc, you would be buying an investment. And the reason why we're saying that as well is that the interest rates are higher. So if it's a house that you're going to live in, you would want that payment to be a little bit lower compared to something that you may be renting out, because you have some rental income, something to offset it. You're not the only one making the full payment. So on an investment property, you know what, that higher interest rate, that may make sense because I don't have to pay that amount. Someone else is covering that and a little bit extra compared to your primary, no one's helping you out unless you're splitting the bills or your family's giving you money. So usually you're making that full payment on your own. So you try to, keep that payment as low as possible. So usually with no doc stuff, I always direct people to just use that as an investment, because you can put the no doc in a business name, like stuff that you can't do on an FHA loan, a VA loan, like you have to buy that in a personal name. So with investment properties, usually you can buy that in a corporation name or an LLC, which that's another show. We can talk about that on another round table. But yeah, there's so many other ways and other things to like protect assets. So the no doc people, I usually tell people do that on an investment property, not, something that you're going to live in. Okay. But if you have to, of course, we know, you got to do what you got to do. So.
Well, that's good to know. We have two more questions. One person said they live in Pennsylvania, and can you buy a house in one state and work in another state? I think you can, but I'm going to
You can, but it has to be a certain distance. So, because a lot of people, well, I want to buy a house in Florida and I work in New York. So it's just not going to work because we know that you're probably not going to live there. And then that would now be an investment property. So more money down, different requirements. So unless you can get a letter from your job stating that you can work from home, and you moving like cross country or really far is not going to change your job situation, unless you're like a 2-hour commute, that's probably like the time distance that we're going to look for. People say I'll drive 3 hours. So just underwriter discretion. I know they usually go with like 2-hour max. But for New York, in Brooklyn, driving 4 blocks is an hour. So it just depends on the location.
That is so true.
But if you live in Pennsylvania, no, because there's so many cheaper houses that are closer to you in that area. It would be tough to say, like, unless you're Pennsylvania to Jersey. I know they're really close. Pennsylvania to New York, but, Pennsylvania to Maryland or something like that is just not going to work. So you can buy a house in another state that you don't live in, just depends on the state. Like New York, Connecticut, New York, Jersey. So, if you're in that tri-state area, then that would make sense. But anything outside of that, it's going to be tough to justify you driving home every day to go home.
Okay. And you're specifically referenced to primary residence?
Yes. You can buy a house in any state if you're buying it as an investment property, because that means you're not living there. Someone else is going to live there. But that's, different requirements. That would want more money down for that. So that's going to be at least 15% down for a single family, 2 family, 20%, 3 to 4 family, 25%. So you can buy a house in any state. You don't have to live there. It's just now there's more money that you have to put down.
Okay. And we're going to wrap it up with one final question. And this person is in Michigan. So we have we have some New Yorkers, and we've got a question.
Someone's proving me wrong. All right. So, but you're worldwide, I see. You're all over it, man. All right.
Yeah, but we have a few additional. And this person wants to know about construction loan.
Okay.
So the person was thinking first of purchasing a home, and we're talking about, the percentage down and what you may need to put down. And then the person said, but what if I have a land, or I buy a piece of land? What do I need to do, and what do I need to go to the bank with if I want a construction loan? So can we talk a little bit about that? And then if we don't have any, we're going to be wrapping up pretty soon because we're coming to time. But can we address that question, please?
Yeah, so as far as like land, then that's something that you would just talk to like a specific builder about. You can still come to us for the mortgage, but if you just have like a piece of land, a builder is going to have to do all of that stuff for you. We did have a loan where you could purchase the land and the construction together, but so there was a program that we can't do anymore since COVID, and that was buying land and doing the construction all under one loan. So the renovation loan that we have now, that's just, the foundation has to at least be there. So if you find a house that's beat up, you can finance the repair costs. So the house, $100,000, you would put your 3.5% down or 3% down or 5% down. You put that down payment, you get your estimate from your contractor, and we add that amount on top of the loan, so you get one loan. So you got 100,000, you put $5,000 down, costs 100,000 to fix, you get a loan for 195.
Okay.
So
But
you're
you,
financing your construction costs instead of, you having to front all the money. If you're doing a brand new construction, you would just deal with the builder to build it, and they wouldn't, you don't have to put up any money for that. They would just build the house for you, and then you would just get the mortgage at the end. So I do a lot of new construction. So people, house is built, they find it, get approved. 6 months later, it's built, and we close on it. So
okay.
it would
So you
just
get
depend on what you're trying to do. Just land, you got to talk to a builder to build it. If you already have a structure on it, then just a contractor, someone that's licensed, insurance, and you do just get an estimate from them. And then we would appraise the house on that, what the house is going to be worth after it's repaired. So you want to make sure that the money that you're putting in, it's going to be justified. So a lot of people, want to do a lot of renovations, but it won't pay to do it. So, hey, you may have to not do that bathroom, or instead of not doing the bathroom, doing the bathroom, because there's certain renovations that will increase the value more than others. So we would need more time to talk about the renovation loan, but on the short end of it is just, you can do it. You're able to finance the costs of the construction work. And a new construction is something different than a renovation loan. So if you just have a piece of land, that's a new construction. So you would work with the builder on getting the price, and then you come to us, and then we would work the numbers on that price. So it would still be the 3% down or 5% down, whatever it is, on the total amount, compared to if you found a fixer-upper, that would be something that would be a renovation loan. New construction would be, just the land or doing all of that together.
Okay. And that program, you no longer offer it since COVID, but there's still a renovation loan that you have currently that's being offered.
So the loan that we had was that you would bypass the builder. So you wouldn't need a specific builder, because you can buy the land and cover the construction all under one loan. So you could have a contractor build a house for you. You don't really need to go to a specific builder and do a new construction, because that may cost more than if you just have a contractor that's just going to build you a house. It's going to be much cheaper than you going to a builder and they build you a house. So you would be bypassing the builder to save money. But now if you want a new construction with land and a house, go to a builder. I would say just find a house with something on it, and you can just fix that up. So even if it's a burnt down house, do that instead of a new construction, because it'll be cheaper. It'll be cheaper for you. But if you want a new construction, go for it. It's just going to cost more money.
Thank you. Well, we're wrapping it up. This is going to be the last question. I'm happy that we've had so many, but I think it's really important so we get this in, because a lot of others, I'm sure, have the same question. And the question is, for a joint mortgage loan, whose credit score does the bank look at? And I think a lot of people have that question. So let's address that. That will be our last question for today. But could you enlighten us, share that with us?
Yeah, we're going to use the lower credit score of the two people. So we see that all the time. Husband and wife come in, or brother and sister, mother, son, and one person's credit's much higher than the other. So we will use the lower credit score. So if you have good credit, good income, and you're married, I would say, buy the house on your own. You can add them on the title so they're still owners. But at least if you can secure it on your own and get the lowest rate, lowest payment, lowest cost, I would do that. If you're going to add someone, it's, you have to do it. So that's what I would say. Or other marital reasons why you want to add them on, but we will look at the lower credit score.
Okay. I know there are more questions, but that's it for today. We are out of time. I want to say a big thank you to Kareem, who we must
Thank you for having me. Thanks for everyone, tuning in. So it was a good talk.
We need to congratulate Kareem. He has been staying up because he's a new dad. So
Yeah.
congratulations once
Thank
again
you.
to you and your amazing wife. I'm happy for you both.
Thank you. Thank you.
Congratulations. But before we go, could you please just let everyone know how they can reach you should they need to, just giving us your name, contact number, and email address. I can certainly pass it on, but if someone is listening and would like to learn how they can contact you, give that.
Yeah, you can text me or on my cell phone, 631-394-7640. I'll put it in the box here. Yeah, because my email is like super long, so it's better to text me and then I can email you my card or something. So yeah, texting me is the best way to reach me now. And then email's better, but texting first and then talk, email. So, but definitely just call me. Or I'm on Facebook. Kareem Baldwin's my name, so you can add me on Facebook. I'm on Instagram. So
Great.
I'm on all the platforms.
Really good feedback. Someone saying I learned a lot. Thank you. So thanks again. And
No
to
problem.
all our viewers, I want to thank you for those who joined on the webinar, for those who joined us live on Facebook. Thanks for joining us. And until next week and another episode of Real Estate Roundtable, have a great day. Take care.
Bye. See you later.